So we're going to use Canada as an example here, but this could be applied to corporations in any country. We're going to assume that our controlled foreign corporation has retained earnings. We've already measured it using U.S. GAAP, and there's no book tax differences. So each of these assumptions adds complexity. It's going to add more accounting fees. So we start with $1 million. No previously taxed income, because remember, we get to deduct the previously taxed income, the Subpart F inclusions or U.S. income from that retained earnings to figure out what's taxable. We're assuming cash and marketable securities valued at $800,000. If we've got a corporation that's been accumulating investments, it could easily be a much higher percentage. So really, when we're looking at what percentage of our Subpart F inclusion is going to be taxed at the higher rate, we need to look at cash and marketable securities as a percentage of retained earnings or the Subpart F inclusion, not what percentage of our balance sheet is cash and marketable securities, because we're going to go first to the cash and marketable securities at market value. We're going to also assume that we've got one shareholder, they're a U.S. person, and when we add all of this to their income, they're going to be paying tax at a rate of 39.6%. And we're also going to assume there's no relevant foreign tax credit carryover. So if you're a U.S. taxpayer living outside the U.S., you really need to be maximizing those foreign tax credit carryovers, because you never know when Congress is going to pass a law that's going to have more tax that you'd like to use prior foreign tax carryovers against.
Or to put it another way, all Americans abroad should always be ready and on guard to pay more tax to the United States, right?
Yeah, well, they should minimize the chance they might have to pay more tax to the United States by maximizing their available foreign tax credit. Right. So, continuing with the numbers here, we've got a Subpart F inclusion. The gross amount is $1 million. And that's equal to retained earnings because we've assumed away all the complexities. Just like most good economists, we've assumed away anything that might make the computations difficult. Unfortunately, when you get to a real return, you can't do that. So that's going to tell us how much. We're going to have a deduction. We're going to calculate it with that lovely little equation. $600,000 deduction, giving us $400,000 net addition to taxable income. That's telling us what tax rate we're going to pay on that $1 million of deferred foreign income that we have sitting in our corporation. Okay. So as I said, well, here we've got tax. The tax is going to be at the top marginal rate, so that's $158,000. Think about that, $158,000 on a pretend transaction.
That's right. No realization event. It's not like you're selling something and freeing up cash. It's just Congress saying, buddy, we want $158,000, but we'll let you spread it out over 8 years.
We'll let you spread it out over 8 years, and that's basically what it would look like if I spread it out over 8 years. So you can see that it's not so much up front, but in years 6, 7, and 8, it ramps up to a fairly good size amount. Yeah, I'm not sure too many shareholders are going to have that in their savings account ready to go.
Well, that's exactly right. I mean, where does the money come from to pay this? I mean, assuming it even applies.
Yeah, so what can we do? So we've put together some strategies here that you might want to consider. Our first 3 strategies increase the basis in the shares. So why do I care whether the basis is increased? Well, when I increase the basis, I'm going to pay less in capital gains tax in the future. Or if I distribute it out as an dividend, it's going to come out first tax-free in the future because of the Subpart F rules. So that means if I increase the basis of the corporation, the U.S. can never tax that income again. So that's good.
That would include on a renunciation of U.S. citizenship for covered expatriates.
That's right. So when a covered expatriate computes the gain on the shares, that gain's going to be less by that $1 million that I've included.
And the gain is less because the basis is increased by the amount of the income that's already been taxed by the U.S., specifically the previously taxed income, correct?
Exactly. That's how it works. So our first strategy here under A is we're going to try and offset that $158,000 with local, in this case, Canadian tax. And the way we're going to do that is to pay a dividend out of the corporation and pay that dividend so it's taxed on the same tax return as the transition inclusion comes in, and to generate enough foreign tax credit. So we need to be careful, though, that we're generating foreign tax credit in the same basket, because foreign tax credit has, for most individuals, two baskets, general and passive. So we want to make sure that we're generating our foreign tax credit in the right basket to offset the transition tax. So that's alternative A. Alternative B, we're going to renounce U.S. citizenship. The reason we're doing that is we want to make sure when we do pay a dividend out of the corporation, there's no net investment income tax on the dividend in the U.S. So,
yes. Can I ask you a question? When I look at A and B, am I right in saying that alternative A means that the tax is paid once, the tax on the dividends is paid once, and alternative B means the tax on the dividend is paid twice?
Absolutely, yes. Yeah, so in alternative A, we're offsetting the, we're getting rid of the double taxation by front-loading the Canadian tax so that it can offset the U.S. tax.
In other words, it can be used as a credit. To put it very, very simply, right, that when this is put on the U.S. return, okay, the amount of U.S. tax is owed, but is in effect paid by the fact that the tax was paid in Canada, and that tax paid in Canada is used as a credit against the U.S. tax, right?
Right. So we're accelerating tax to Canada. This is something you never want to do when you're tax planning. We're accelerating tax.
Yeah, because it erodes the capital, correct?
Because it erodes the capital, exactly. So in B, we're saying, okay, we don't have the cash to pay it out of our own savings, so we're going to pay it out of the corporation. But we don't want to front load enough Canadian tax to offset the whole thing, because that's eroding our capital. So we're just going to pay enough of a dividend to pay the tax to the U.S. And we're fed up with the U.S. changing the rules on us. We're going to renounce. And one of the reasons we have that assumption that we're going to renounce is to avoid any U.S. tax implication when the dividend's actually paid. Now, of course, it's already been taxed for income tax purposes, but net investment income tax, the net investment income is a completely separate tax scheme. And so therefore, you have a completely separate set of tax books for your net investment income. And the dividend comes into net investment income, not when it's deemed paid, but when you actually get cash, unless you make an election otherwise. So if we renounce our U.S. citizenship before we pay the dividend, then we don't have net investment income tax on that dividend. Okay, and we're going to generate only enough cash to pay the transition tax so that we're maximizing the deferral that we get in Canada by keeping the assets inside the corporation. Okay. Alternative C is saying we're not going to pay a dividend. We've got enough savings, or we can mortgage our house or even sell our house. Of course, if you're going to sell the house, do it after you renounce so you don't pay the U.S. tax on the gain on the sale of your personal residence.
Just pausing there. I think this is an extremely important point. I could imagine that for a certain number of people, renouncing and then selling the house so they get the tax-free gain on the house might be the way they might actually deal with this. If they think they need to pay the U.S. this tax, it's one way. It's one way to deal with it. Certainly. Let's say they're downsizing, but they don't want the erosion of their pension plan, right?
Right.
they're living in a house that's too big for them. They say, well, I really don't want my retirement, my pension plan confiscated because I need that capital to generate income for me. My house really is not generating income. So maybe what I'll do is I'll renounce, and I'm renouncing specifically so that I can pay the tax to the United States. What I then do is sell my house, which frees up tax-free cash, and then pay the money to the United States. In other words, it seems to me
that's a strategy somebody could easily.
Yeah, I think it's entirely rational. Absolutely. I mean, why should an American abroad have a house anyway?
I don't know if I'd go that far, but why should they have a big one? Okay. So the fourth strategy here, which gives you a little bit of increase in basis, but not much. This one's quite different. Okay, here we're going to elect under Section 962 to be taxed just like a corporation on that subpart F inclusion. That means we'll get the 15.5% rate, but the other advantage is that we can use the tax that's already been paid by the corporation to offset the U.S. transition tax. And this, for some, is going to really minimize the amount that's due, the damage. Okay, so when we make this election, it lets us do exactly what multinationals do. They get to use the tax paid by their subsidiaries as if they had paid the tax directly. It's a deemed foreign tax credit. And that means that we're using tax that's already been paid, but there's a trade-off. The trade-off is that there's a minimal increase in basis, so we could end up paying more tax when we actually sell the shares or distribute the cash.
And the increase in basis, as I understand it, is the amount of actual tax paid to the United States.
It's the amount of actual tax paid to the United States. Okay, so how do you choose? Which of these are you going to do? The considerations are you going to renounce? Are you going to do it soon? Because if you're going to renounce soon, then future U.S. tax may not be an issue. And if you're a covered expatriate, then the basis may be a big issue for you because it may change the amount of the exit tax you might have to pay.
Yes, precisely because it's a deemed capital gain, probably, okay? And capital gains taxes are generally calculated as the difference between what you sell and your adjusted cost basis. And subpart F inclusions increase the cost basis, which would therefore decrease the amount of the capital gain.
Right. So if you're going to expatriate soon, you might want to maximize the basis. You have to run the numbers. You don't know because all of these things can interact with other items on your return. Whether you have a foreign tax credit carryover, whether you're subject to the net investment income tax. There's all sorts of other thresholds based on AGI, et cetera, that can make an impact in how much tax you end up paying for this. So if you're not a covered expatriate, that Section 962 election may very well minimize the impact. It's also true if you're going to remain a dual taxpayer when you finally sell or dividend out the income, because most likely any Canadian tax due is going to completely offset any U.S. tax that's due.
And even if it doesn't completely offset it, it clearly can be used as a tax credit.
Right. So if you're a covered expatriate, you need to get advice. And you're going to need to get high-end advice because your accountant around the corner really just isn't going to know this stuff. Okay, now we get to go on to the numbers. So here are some numbers. So I'll walk through each of these in turn. We'll start with A. So in A, we're basically using the individual Canadian tax, so paid on your individual return, to offset the U.S. tax. To do that, we come up with a dividend that's enough to generate $158,000 worth of Canadian tax. That means we have to distribute $338,000 out of our corporation. And yeah. So that means that there's a lot of money that's going to be out of the corporation now and no longer generating tax effective returns. We're going to pay U.S. tax. Remember, I said the net investment income tax occurs when there's actually a dividend. And so here we have an actual dividend. So we've got some net investment income tax. There might be some treaty position you could take to avoid that. At the moment, we're going to assume that that's not the case.
But the key there is that you need the actual dividend paid to generate the Canadian foreign tax credit to offset the U.S. tax.
Right.
Necessarily puts you in the position of very likely having to pay the 3.8% net investment income tax as well.
Right. And so that means if you pay the net investment income tax, you're going to be paying a total of $171,000 in tax. Your U.S. tax basis, it went up by $1 million from the Subpart F inclusion, and then it went down by $338,000 for the dividend, which was not actually taxed on the income tax in the U.S., only for net investment income tax. And you're keeping separate books there, which is very, very confusing. Okay, so that's A. B, we're going to pay this tax out of money that's inside the corporation, which means it has to get out of the corporation to pay the tax individually, which means a dividend. But we're going to do the dividend after renouncing so that we don't have to worry about that net investment income tax. And so the dividend amount is going to be the $158,000, generating $74,000 of Canadian tax. No tax credits allowed. We are being double taxed here because that $74,000 of tax is on the same income that we've just paid the U.S. $158,000 of tax on. Great. We're paying a total
tax. You're no longer a U.S. taxpayer.
You're no longer a U.S. taxpayer. So because you're no longer a U.S. taxpayer when you make the distribution, really when you want to worry about your basis for the exit tax. After that, your U.S. basis doesn't make any difference. So at the time you renounce, you haven't yet paid the $158,000 dividend. So your U.S. tax basis is $1 million. Right? Okay, option C, we're going to use personal funds. We're going to use our savings account to pay $158,000 to the U.S., or we're going to sell our house. Whatever, we're going to use money that's outside the corporation. That means that we're only going to pay $158,000, and we're going to have $1 million basis in our shares. But it also means that eventually, when we do pay out this money in Canada or wherever we live, we're going to be paying local tax on it, Canadian tax on it, on income that we've already paid tax to the U.S. on. So we're guaranteeing ourselves to be double taxed. Okay.
Both options B and C guarantee double taxation. Have I got that right, Karen?
That's right. Both B and C guarantee double taxation. Okay. So now, alternative D, we're going to use the Canadian tax paid inside the corporation to offset that transition tax. And so we need to know how much the company pays in tax. So I've done the numbers here based on a 15% corporate tax rate. And that's going to end up with $94,000. And I'm going to go through that in a lot more detail in the next slide. Okay, so in order to use alternative D, we're going to make that Section 962 election, which is not simple.
Right. Okay. So Karen, just to kind of keep track of what's going on here. So alternatives A and D are making use of tax paid either individually or by the corporation to offset U.S. tax, correct?
That's right. That's how it works.
B and C do not.
B and C do not have any foreign tax credit in them. So you're going to be paying once in the U.S. and then later in Canada on the same income.
Okay. Thank you.
Okay. So basically with a 962 election, they say you can use the tax paid inside the corporation as a deemed foreign tax credit. But the cost is that we don't get to add that $1 million Subpart F inclusion onto the tax basis of the shares. All we get to add is the actual U.S. tax we pay. So that's going to increase the exit tax if you're a covered expatriate. So how does it work? Well, basically what we're going to do is figure out how much taxes your Canadian corporation paid since 1986. Gosh, that sounds hard to me. But we're going to go back and find out how much you've paid since 1986 on all of that $1 million of deferred foreign income. Now, we've been able to take a deduction in our case of 60% of the deferred foreign income so that only $400,000 is taxable. We're going to take our total taxes paid to Canada and reduce that by 60% and take the remaining 40% is our deemed foreign tax credit. Okay. So in order to earn $400,000 after tax in Canada, the company must have earned before tax $471,000. Because if you take $471,000 and take 15% of it, you get $71,000 tax. So we earned $471,000, paid $71,000 in tax to Canada, and we're left with after-tax income of $400,000. So that's basically how we're going to be taxing this $400,000 net subpart F inclusion. We're going to add $471,000 to our taxable income. That $471,000 is going to be taxed at the corporate tax rate of 35%, generating tax of $165,000. And then we're going to take the $71,000 paid to Canada as a foreign tax credit, leaving us with $94,000 to pay to the U.S. So instead of paying $158,000 for the transaction tax, we paid $94,000.
And that can still be paid over the 8 years, correct?
That can still be paid over the 8 years. Right. But that $94,000, that depends crucially on that assumption I made that our corporate tax rate is 15%. So if our corporate tax rate's different from 15%, the result's going to be different. And the higher the corporate tax rate, the lower the tax we're going to pay to the U.S. Right. So we've got $94,000 at 15%. If our corporation's paying an effective tax rate of 35%, we will owe zero on the transition tax.
Right. But of course, that's really impossible because the U.S. has had the highest corporate tax rate in the world.
Right. It's impossible. The U.S. is going to get its slice of, whatever, 35% less your local effective corporate tax rate on the $400,000 that you're net including.
Right, and you don't get the step up in basis.
Your step up in basis is the amount of tax you paid. So at 15%, that was $94,000.
Yeah. Mm-hmm.
Okay, is it all clear as mud? Yeah, it's about as clear as tax can be, I think. Anyways, so from all of that, those were the numbers. Let's boil that down to some general principles. Okay, so if you decide that this transaction tax applies to you, transition tax applies to you, then, because there is no transaction, it's just a transition, alternatives A and D minimize your U.S. tax because you're using Canadian tax paid as a foreign tax credit. In alternative A, that tax is paid by the shareholder, and in alternative D, it was paid by the corporation. Okay. Also, in alternative A, all the United States got was $13,000 net investment income tax. All of this repatriation, they called it, to collect nothing. And then in B and C, like you said before, it's going to guarantee double taxation, and the U.S. is going to get the full $158,000. The damage done is going to be determined by cash and marketable securities relative to your deferred foreign income. Okay, not relative to the rest of your balance sheet, but relative to your deferred foreign income. Okay, and everyone's situation is different. We had to make a ton of assumptions to get to these simple numbers. So if you're going to put this on a real tax return, you've got to run the numbers as many times and get appropriate professional help.